Well, hi everyone. I'm Gary Lapointe. I'm on the faculty of the Supply Chain Department at Syracuse University and co-director of the Salzberg Award Program, along with Fran Tucker, who's also here today. And I would like to welcome you to our Salzberg lecture series. Today's topic is logistics mergers and acquisitions. Will corporations still ride the bull market? We have a terrific panel lined up to discuss this topic today. And just a little bit about logistics. We'll have about 45 minutes of discussion, and we'll leave about 15 minutes towards the end for questions and answers. And you'll notice on the bottom of your screen a little tab for Q&A. And if you want to type your questions into that, and someone will pick that question up and ask that a little bit later. I'm going to begin by introducing our moderator for today, Ron Liebman. Ron is a partner with a law firm, McCarter & English. And Ron is widely quoted and is frequently called upon for his expertise in supply chain law and digital commerce. So Ron, how about if I turn it over to you?
Thank you, Gary. I hope all is well. Good afternoon, everyone. A particular hello to anyone and everyone in Syracuse. I have a very warm spot for the University up on the hill. I've been in this field a very long time, and through most of that time, no one I knew who was not in the field understood what I did, a lot of glassy stares. And it began to change in recent years, but along came COVID, and the president, or now presidents, governors, and Anthony Fauci almost daily talking about what a supply chain is. And it got further to the point where if you open your morning paper, well, electronically at least, you will see stories about e-commerce growth, be it Amazon or otherwise, last mile delivery, forward warehousing, labor issues, galore, and the beat of technology as we seek to rationalize the supply chain. And this has been noticed by the investment community. And that's why we're here today, as Gary said, we're here to discuss the current environment in supply chain and logistics investing. And with us are three experts in the field with disparate backgrounds who will take us through where we are today and give us a look into the future. So let me start by introducing them. Josh Putterman is founder and managing partner of Jacksonville, Florida-based Blue Jay Advisors. Blue Jay focuses solely on the transportation logistics space and has done so since 2013. Blue Jay consults and advises clients principally around transactions through retained buy-side searches, sell-side mandates, and due diligence and market research assignments. They also have a business doing federal grant applications. Prior to founding Blue Jay, Josh spent 16 years at the CNX Railroad in various operations and finance roles. Before that, he was vice president of strategic relations for the railroad holding company Rail America, and he holds a degree in economics from Johns Hopkins University. Up next is Jason Seidel. Jason is managing director of Cowan & Company. He's been with them since 2013, and he covers the freight and surface transportation, generally recognized as the top person in the field. Prior to this, Jason spent 4 years actually working in the industry in the trucking and parcel space. He holds a bachelor's degree in transportation distribution management from the Syracuse University and an MBA from Rutgers University. He's a member, as a Paul, who you'll meet, and myself in the Franklin Supply Chain Advisory Board for the Whitman School of Management at Syracuse, president of the board of directors of the Northeast Association of Rail Shippers, and a contributing editor to Railway Age. Last but not least, we have Paul Swivland. Paul is the Chief Executive Officer of STG Logistics. STG is the largest deconsolidator of less than container load freight in the United States. I just found out very recently, handling about 35% of that function as a whole. At STG, Paul handles the strategic leadership. He works closely with the executive management teams to oversee business planning, acquisition strategy, operations, sales initiatives, profitability, cash flow, and other business goals. Prior to STG, Paul was the CEO of truckload carrier Celadon. Before that, he was CEO of transportation rigging company Farron International. He's the former CFO of Pacer International and now, which is now XPO Intermodal. And I have to apologize. I have a head cold, so please bear with me. And the leader of the was the leader of the transportation logistics consulting practice at Alex Partners. Paul serves on the board of two PE-backed companies, BDP International and Stellar Environmental, as well as one public company, Roadrunner. He's earned a bachelor's degree from Syracuse University and an MBA from the Wharton School of Business at the University of Pennsylvania. Okay, so let's get started. Jason, you're up. So from what you've seen and looking forward, do you expect to see continuing significant investment in the supply chain logistics space? And if you do, where do you think that'll be?
Sure. Thanks, Ron. It's a pleasure to join you and the esteemed panelists here today. So if you go back and you look prior to COVID-19 hitting, I would say a lot of companies were well positioned in the public markets to participate on the M&A side. And then, COVID just put a lot of things on hold for people. They probably couldn't have predicted things would have gone so well for the transportation space in terms of the financial aspect. Once we cleared second quarter of last year, freight came back in third quarter pretty strong. We had, in some cases, record fourth quarters for people, and 2021 has started off pretty strongly. A lot of the companies that I follow, and I follow 24 different companies in the public markets for both the rail, trucking, and logistics space, are in very strong financial shape, and they are back in the markets looking for acquisitions in many times. And there's been several that have been announced, and we can go over some of them, the largest of which has been the announced transaction for UPS Freight, which is the old overnight. I suspect that you'll see continued M&A. I think the logistics sector will stay hot, and that includes brokerages. I think you could see even some M&A on the trucking side. Maybe some people do some tuck-in acquisitions, particularly in the specialized truckload space. I think there's some appetite out there right now for that. From what I've seen, and I think Josh can probably go into this a little bit more, but I think, multiples right now are fairly healthy. And I think that's a sign that you have good supply and good demand that's out there in the marketplace. So I'm looking for a strong M&A environment from the analytical side this year, with companies that are, at least in the public markets, well positioned with strong cash flows and good balance sheets to do it.
Jason, I've read a lot recently, though, about the LTL market, and we do have the UPS deal. Do you think that is a portent of things to come, or is that a one-off?
I think that's the biggest one that we're going to see. So I don't think there's going to be any other large transactions, at least in the near future, unless a SPAC would come in with a really, really large opportunity to take one of the larger private carriers public. The LTL space has been a favorite of the investor community because they've realized over the past 10 years that, they've just taken rates up every year. So no matter what the environment, as I like to say, they're good oligopolists, right? Your top 10 players control roughly 80% of the for-hire marketplace, and they've been taking prices up every year. Now, UPS was a little bit different. UPS Freight was used as a loss leader for them to get more parcel business. So effectively, you've just made a strong market even stronger with TFI coming in and taking over UPS Freight, and now focusing on profitability. And they've publicly said that they're going to raise rates, which in some cases are a good 15% below market. So do I see any of the existing LTL players adding on in a large way? No, I don't. Could we see some movement with SPACs? Absolutely. You could see somebody come in with that. It's a very, very hot investment market, and you're getting more and more longer term investors, some of the bigger long only shops looking at the LTL space.
Thank you, Jason. Josh, same question, but since your sweet spot is in the private markets, just what your view is for private companies going forward.
Thanks, Ron, and thanks for the opportunity to speak today and with the rest of the panel. The last couple of years, I would say in particular, has been really a robust, to Jason's point, multiples at, I've been in the railroad space for 30 odd years and working with short lines specifically for almost 15, and they're, up 50 to 75% of when I started in the business. So I think that's going to continue. There's more and more new entrants into the space, which I think is part of what is driving it. There's just a lot more capital interested in transportation and logistics, and that's railroads, that's asset-based trucking business, it's non-asset-based 3PLs, it's port logistics businesses, things like that as well. It's just become an incredibly hot space. And I really don't see anything slowing that down. And in fact, to your point earlier, I think COVID is probably a catalyst for increased interest in the space as opposed to any reluctance for folks getting in there. So I would say I'd be pretty bullish on 21 being an even bigger year than 20 was. I mean, 20 obviously had the subdued period where there wasn't a lot of transactions for several months, but it wasn't because of people's interest. It was because of, I think nervousness and how are we going to come out of it, and uncertainty, and frankly, lending tightened up significantly for several months. But now it's sort of back with a vengeance, and deals that were held up during the COVID period are sort of back and coming through the pipeline. And if you saw the Mode Transportation announced they bought Avenger Logistics, and that was another one that was held up during the call it quiet time during COVID. But I think you're going to see more and more things in the pipeline and announced.
Yeah, to either of you two guys, much of the press has gone to the tech side of the business, the brokers, things like that. Do you see increased looks at more traditional brokers, more traditional freight companies, 3PLs and stuff, and so at least not all the interest that apparently has been on tech in the past? Do you see any move in that direction?
Ron, yeah, I think I do. When I look at some of the companies that I follow, I think what they're looking to do is add on operations that are sort of adjacent to what they're already doing. So maybe some niches that they don't already have. For example, if you're a traditional broker, you might not be really strong in the temperature control markets, or you might not be really strong in the specialty truckload markets, and they can add that on. So this is what a lot of the companies are looking to do. They're looking to strengthen their product offering to their client base.
Yeah, I think I'd agree with that. I think I'd agree with that as well. You're seeing, kind of expansion of both commodity and then equipment type diversity. So a guy that's been nothing but a dry van carrier is moving into flatbeds and things like that. So I think you've seen more of that. I think overall, Ron, your question around technology versus sort of the more traditional, I think part of why we're hearing so much about technology is you have a lot more, between Amazon and others, it just makes it pretty sexy sounding in terms of how it plays into the press. But you're seeing lots and lots of activity on asset and more traditional brokerage-based businesses as well.
Paul, your turn. You've been sitting so quietly. Paul,
patiently waiting and listening to all these brilliant comments.
Okay,
Yes.
And feel free to comment on anything that has come before, by the way.
Well, I would just add to what they both said. I would agree wholeheartedly, but I would add that the market, just to put in perspective, the private equity firm that owns my company that we work very closely with, they have received more deal flow in the first 6 weeks of 2021 than they received in all of 2020 in the transportation space, just to put in perspective. Like that's, and I think what's happening is the sellers, the price that they're thinking at when they were when they were kind of in the end of 2020, I think their expectations were high, but I think the buyers' expectations and their multiple levels are coming up. And so now we're at a point where they're close to equilibrium and deals get done. So I totally agree with what was said before. 2021 is going to be a blockbuster year, I think, in the logistics space as far as deal flow.
Paul, you're in an interesting position vis-a-vis the rest of us talking today, in that you're actually the CEO of a portfolio company of a PE, in your case, Windpoint Partners. So what is it like, for your company and for you in the current environment from an investment standpoint?
Yeah, so I would say as CEO, so first of all, I've had the privilege, thankfully or unthankfully, to be CEO of a publicly traded company, a COO of a publicly traded company. I was chairman and CEO of another private equity owned company, and what I would say is working for a private equity firm, I think the reality is you got to remember a PE firm, they invest money for their partners, their limited partners. That's their sole goal and sole focus. And so the way they build their track record and build raising the opportunity to raise more money and raise additional funds is to have success. And so when you work for a private equity firm, I think you have to be very focused on the number one thing is grow, grow, grow. And you grow through acquisition, doing good, smart M&A, and the simple formula 1 + 1 should equal 3, right? So you acquire companies. First of all, you should get what they call the EBITDA arbitrage. So you buy it at a lower multiple, but you're worth a higher multiple. But then secondly, you should get the synergies from it, right? And so you shouldn't be doing the deal unless there's a lot of synergies and value that can be obtained post the deal. Secondly is you have to be able to also grow like crazy organically, right? It's one thing to grow through M&A, but you have to be able to show that the base business can grow and that you have a model that can be sold and people are buying it. And then I would say the third thing is you have to be prepared to live and work in a highly levered environment. And what I mean by that is that typically a private equity firm, they cut an equity check, but they are going to get as much debt on that business as they believe the business can handle. And so again, that's how they play the game. And so you could be 4 or 5 times leveraged on an EBITDA number, right? And so there's going to be covenant issues. There could be a lot of things tied to that, in which you as CEO, you have to be on top of, you have to measure, you have to have a CFO who understands dealing in a leveraged world. And so that's just a different type of environment. But if you're successful, it could be wonderful, right? And then the final thing I would say is, being on the board of a publicly traded company, those board members, as much as they care and they want to see the business be successful, they're not close to the business. They're not there on a day-to-day basis. The private equity firm typically has board roles, and they are very much more attuned to what's going on in the business. And so the board meetings can be substantially more challenging because they're more demanding of you. They ask more challenging questions of you, which is good, right? Because you want to do the right thing and be more successful. But it's a very different dynamic as far as dealing with oversight and with the board leadership.
Thank you. Josh, we started speaking for a little bit about the technological firms, and you could call that AI, autonomous, e-brokers, WMS. There's a zillion things out there. But why do you think so much money is going into proving technology nowadays as compared to just technologies that we know work?
I think a couple of reasons, Ron. Everybody on the panel here has been in the transportation space for 25 to 30 years. And, let's just say this is not ground zero for where all technological improvements are made in our country. I mean, the transportation industry is definitely a follower, not a leader. So I think part of it is trying to change that position to a certain extent. And as you have new capital coming into the business and more technologically focused firms recognizing the size and space and scale of the logistics business and trucking in general as well, it's a huge marketplace. It hasn't had a lot of capital put towards technology in the space, so it's rife grounds for it. And I think that that combined with the Amazon effect, as I mentioned earlier, I think is driving more and more technology capital to transportation and logistics.
Anyone else? Any thoughts on that before I move on?
I have to agree with Josh here. Also, from the investor standpoint, investors are really looking to find some of these smaller companies that sort of might be the next Apple or might be the next Amazon or Tesla, if you will. What I found over the last couple of years, investors have been willing to wait a little bit for profits if they think a company is going to put themselves in a leadership position that's sort of on the cutting edge of technology. Whereas if you go back maybe 15 years, there was a little bit of a reluctancy in the investment community to do so.
Thank you. Paul, there have been several deals recently involving 3PLs, warehousing, and the space you are in. I mean, Ridgemont acquiring Seiko pops into my mind, for example. Why do you think that space, we've talked a lot about in general why things are hot. Why do you think that space is hot and will remain hot?
So I think, not, excuse me, my thing keeps popping off my email. I think the reality, this pandemic has really changed the way people think about supply chain and think about business and think about freight flows and the likes. And, there's a terminology that I think we all learned, like when we were back in school, Jason and I, back in TDM classes, talking about nearshoring. To me, there's a new phenomenon going on. I'll call it near storing. And I say near storing because you're not going to change the global supply chain overnight. I mean, China's not going away. We're going to continue to see manufacturing in China and Southeast Asia. But what I think the pandemic has proven is that people want the goods closer to home so they can store so they can resupply the stores much faster. And so all the safety stock and everything we learned about, I'm not so sure how well that's going to hold up going forward, just because people want the materials and the products much closer to them, kind of in a position where they can have 24, 48-hour store delivery. And so I think that has put a big spotlight on the 3PLs in the warehouse space, and some of the deals you've seen have gotten done. They're going for some pretty good sized multiples, and I think that's because the expectation is you're going to see nothing but growth in that area in the coming years.
Yeah, I'll give some commentary here.
Great.
I am seeing with my clients forward stocking all over the place and resourcing back to the US. I'm also seeing from my clients doing several warehouse deals recently that there are parts of this country where there's just no warehouse space left. Chino, California is a city I think of, for example, and you have places near there. There's just, you can't find space if you try. That's significant. So I think you have a loggerheads here. I think on the one hand, absolutely agree, people are going to look to near source, to resource, to in-source, whatever you want to call it. But I think a good investment place, maybe in the real estate business for these warehouses, because there is definitely right now in some of the key areas, port areas, shortage of buildings of size that in particular warehousing of retailers can take place. And that's just something I'm seeing. I don't know if you guys see that too.
Yeah, Ron, and it's not just big places like California. We did a call a short while ago with the trucking and logistics executives, and there was somebody on from Maine. They're a warehouser and small trucking operation from Maine, and they had absolutely no space left in their warehousing operations up in Maine.
Yeah, I think I would add to that as another portion of the geography is, we're in Jacksonville, Florida, and I was talking with my commercial real estate broker, and he said there is quite literally no warehouse space available in town.
Right. I mean, it's brutal out there. And so, Ron, what I would say we're doing within our company, especially there in Southern California, where we have called half or a dozen facilities and close to 2 million square feet, is we are pushing more and more east. Right. The stuff that doesn't have to be near the port. So if we're like a distributor, if we're running a distribution center for the West region for a retailer, that stuff can move further from the port. But if we're doing transload operations and or our LCL breakdown operations, that needs to be closer to the port. And so we're rationalizing what we do where, because it's brutal. I mean, we're seeing as much as a 50% increase in the rental rates, lease rates. It's that bad.
As I said, we all want to be landlords.
Yeah. Well, we should have been landlords 2 years ago. So then we'd be very well positioned.
Okay. Well, to everybody. So we've off and on talked a lot about TransTech. And so I just want to get more of a general view, or maybe of each of you, which part of tech you think may shine above all others. And the second thing is at least you three guys know, I have a real interest in these valuations. And so do you have expectation that these massive valuations based purely on growth and sometimes supposed growth will continue, or as a lot of these so-called e-companies and tech companies begin to hit their middle age, that they'll be held to the same sort of profitability standards as a traditional company is.
Josh, you want to go? You're looking like the
That's Ron to call on someone.
Oh, yeah, sorry there. We were trying to be respectful of each other, Ron. We were hoping you'd pick somebody.
I said to all, go ahead. Okay, Paul, you're there. Speak.
No. So to me, ultimately, you have to make money, right? But at the beginning, it's all about the growth and grow, and then you have a proof of concept. You've grown it, you've proven people will pay for it, but then ultimately you need to make money. And I would say a good example is probably Amazon. If you remember the beginning of Amazon, they weren't making money at all. Right. But now ultimately they make money. And so I think in the technology space, there's a lot of areas of opportunity. And I think a lot of investment is going into technology. But fundamentally prove that you can grow it. Step one, but step two is ultimately has to make money.
I would concur. Again, we're still in a stage where I think investors are willing to wait a little bit if there is an idea that they perceive to be sort of groundbreaking, if you will. But you mentioned also in part of your question before, Ron, that like what areas do we think are going to be hot? And I would tell you from what I've been hearing and what I've been seeing, I would say autonomy as well as robotics are going to be two areas that are going to be very, very important in transportation space in the coming years.
Yeah, I think I would going to say about on the autonomous side, I think that's where we're going to have to see the most patience from investors. So it'll be interesting to see how much they actually have, because I think I think there's been lots of press about it. There's lots of people working on it, but I'm not sure how close we are from using it for autonomous trucks for example. I'm not sure from a practical matter how close we are to it being in the day to day, as it were. So I think you have to see investor patience in some of those areas. But I think it's kind of rules of investing, right? People are only patient for a certain period of time. So to Paul's comments, sooner or later they got to make money. I don't think there's anything unique about transportation or the technology going into transportation that defies that law.
Yeah, and I think with autonomy, I think the technology is essentially here.
Yeah.
If you look, there's plenty of companies that have done the road tests, with the drivers in there, but the drivers do not assist the computer on round trips from long distances, right? And through all different times of the day and rush hour, if you will. The issue is going to be getting those trucks out there, getting the public acceptance, getting the insurance companies on board, getting the local governments on board. That's going to take time. And really, you're going to be converting an entire industry over from sort of that traditional just driver-based diesel truck to, probably a truck that ultimately is going to be an alternative fuel autonomous truck, 25 years from now. And these things are going to be expensive. And if you look at the trucking industry and the dynamics that are around it, most trucking companies own 6 or fewer trucks. And they're not buying the brand new Peterbilts that are tricked out for $140,000 right now that are a traditional diesel truck. They're buying the used truck in the marketplace for $35,000 to $40,000. And if you look at the price tags on these newer vehicles, you're looking at anywhere, depending upon what type of vehicle you buy, of $200,000 to $400,000. And even if you've got government grants, the problem is going to occur that how do you pay taxes on that? Because you have to pay taxes on a purchase of an item based on its value, not the fact that you didn't actually pay for it yourself. So I think there's some tricky hurdles that you're going to have to get over. I think ultimately you're going to put the trucking industry in the hands of a select few versus the massive fragmentation that we're seeing currently.
Well, hey, Ron, what I was going to say is, I mean, look at the airline industry and look at airplanes, right? I mean, the reality is you still have 2 pilots up front, and airplanes can basically fly themselves. And I just fundamentally, we talk about driver shortage every day, but the driver shortage problem is really about the trucking companies agreeing to help drive up their pricing, because we don't have a driver shortage problem, we have a driver pay problem. And ultimately, we have millions of people in this country who drive trucks. And so I think what you're going to see is ultimately technology will win out. But I think it's going to be a lot longer before we see a truck on the road without a driver behind the wheel. Not that we ultimately won't get there, but the hurdles are going to be crazy. And I think the reality is, again, you just have many, many jobs at stake.
Well, to Paul's point, I believe in 28 states, the most common job title is truck driver. So it is a very big job killer right now, if you will. But I'll actually take it a step further. I've been around trucking 30 years now, and drove for a little bit. But I'm seeing companies right now putting through driver wage increases. That's the highest they've ever seen in their company's history. And Paul ran a truckload carrier. Most of these companies are doing that, and they're just keeping their driver pool flat right now. I think what autonomy can do, at least in the interim, is take away a portion of that market that's been hard to fill, which is sort of that longer haul portion. I think you can see autonomy taking away a lot of the line haul and a lot of the truck driving jobs being more local, getting the driver home every night, getting them a better work-life balance, which is not existent in some parts of trucking. So I think it could actually help a driver in terms of, or at least the driver job, if you will, help it look better and maybe potentially attract more people to it in the long run.
Yeah, I think, we have to move on, but just my quick thought on this is that if you're an investor looking at autonomous, if you're looking at electric, if you're looking at any new technologies, you also have to wonder about infrastructure. The country has to have a massive upswing in infrastructure for all these technologies to work to their max. Now, as everyone said, of course they will. But you need electric charging stations, you need roads that have lines on them, you need all these things that we don't think of. So while there've been massive tests in Texas of 500 and 600 mile runs, and they work, the question is, when will they work in the cities? When can they go on back roads that essentially are one lane and often not even paved? And I think that's really the holdup point. It's as much as all the issues that the guys said, but the infrastructure having to allow these things to work. Okay. Jason, you mentioned SPACs before. And there is no way we could finish this discussion without talking about SPACs nowadays, except I went back to beginning and said how long I've been doing this. And I love when I see in the papers how SPACs are new. SPACs prove everything old is new again, is about what they do. But so my question is, why are these blank check companies looking at the transportation space? Why is so much money seemingly aimed to the space we've been talking about all afternoon?
I actually don't think it's just at the transportation space. I mean, there are SPACs being created, on a weekly basis, and my company is one of the many companies on Wall Street that are participating in this and helping bringing these companies public. And I think what you really have to go back to is it's investment money looking for a home, and it's also clamoring for more publicly traded companies. The amount of publicly traded companies have been declining over the years. And now I think this is proving that there is a market for more publicly traded companies, and that's one of the myriad of reasons I think that SPACs are coming back into the marketplace. It's just an easier way, I think, to come public. Now, I will say this: I wouldn't be surprised if we see increased regulations around SPACs, and I know a lot of the regulatory bodies are actually looking into that as we speak right now.
Okay, so we should expect to see some deals announced, I would think, soon then. Okay.
There have been record amounts of deals. I can't even keep up with the amount of emails that I get from my company, and whether they're a public deal or a private deal, every employee gets an email, and this year has been crazy.
Okay. We have one question, and I think maybe we'll answer that, and then each of you guys could take a couple of minutes just to close this thing out. So the question is from someone I think I know named Ed Gallagher, and he says, do we believe Amazon will seek to grow organically or via acquisitions?
Yes.
Truly both. Yeah. I would say Amazon, there's no doubt they're going to continue to grow organically, but I would say They're actively looking at different type of deals. And so I wouldn't be surprised if they made a bold acquisition before the end of 21.
I think one of the things Amazon has been consistently doing over the last, let's call it 5 to 7 years, is they've been looking to insource as much of their supply chain operations as they can. They want to be in more control of sort of getting their product to the consumer, right? That's their ultimate goal. And now you saw the way they've sort of had that workaround to get away from some of the parcel carriers and postal guys is essentially start up, or having people start up their own businesses, being that blue truck that comes through my neighborhood, by the way, twice a day, once in the morning, once at night now. So these are entrepreneurs that I think can own up like upwards of 20 trucks in an area and run their own business for Amazon. So, they're being creative. They're trying to put capital to work without owning a lot of assets. But, I think to Paul's point, if we were to see a more asset forward purchase, that would be very interesting with them. It's not too long ago that FedEx basically kicked them out as a customer. And now it's pretty much UPS and the Postal Service that does a lot of the work for Amazon.
Josh, any thoughts?
Yeah, agree. I'm not sure the question or why it had to be an either or, because I definitely think it's both. And if you add into that, not simply acquisitions, but just the investments they're making in transport, jets, trucks, et cetera, containers. I mean, if you look at a, busy railroad main line now, it's all smiling boxes going by. It's amazing how much capital they put into the space. And I haven't seen anything that would indicate they're not going to continue that.
Okay, so we have a few minutes left. So invite each of you, if you can take a couple of minutes each and just sort of sum up where you think the market is and what folks should know. Josh, go ahead.
Thanks. Again, thanks for the opportunity. It was a pleasure being with all you guys. As I mentioned earlier, I've been in the transportation business for 30 odd years, and it has gone from, being a part of the economy that was simply taken for granted, that no one ever talked about, to, where sexy money is going and SPACs are spending, to your point, the blank check. I remember when I started in the railroad space, my mother didn't even know that railroads existed anymore in terms of moving freight. And now, the capitalization for all the big railroads is in the many, many, many billions. And, and Warren Buffett owns one, and Bill Gates owns a lot of another one. So I think transportation and logistics investment is going to continue to be very strong, very robust. As you see the supply chains of the country turning over, I guess, with COVID, I think that's been a tremendous catalyst. But I think the regular kind of blocking and tackling aspects of the economy, asset-based trucking companies, third-party logistics businesses, short-line railroads is now drawing even more and more attention. You've got infrastructure funds that now consider railroads infrastructure. For many, many years, they wanted an ongoing annuity kind of a check to be qualified as infrastructure, power or other recurring kind of toll roads and things. And now they're willing to make investments in railroads. So the competition for acquisitions is growing greater and greater because of the new money that's into the space. And I don't see anything, again, that's going to change that. I think, to Paul's point, I think 2021 is going to be an incredible year for acquisitions. And, it's a fun time to be in the space. It's finally become popular. I like being here now.
Paul.
Yeah, I was just going to say, I mean, if you, and Jason, I'm going to age you and I, right? So we graduated from Syracuse as TDM, Transportation Distribution Management majors, back in 1993. And, there's been an evolution, right? So TDM became logistics, and then logistics became supply chain. And I mean, I think the reality is it has evolved. It's evolved a ton. And I would say, if you're in big corporate America and you were in logistics, it was like being an offensive lineman. The only time you got any attention was when you got called for clipping. And so, right. So what's happening now is that it is getting to the forefront. And I would say I kind of have two examples that are near and dear to my heart. One is obviously the pandemic and the vaccine, and our inability, we can make the vaccine, Pfizer and Moderna and J&J can crank it out, but we can't get it into the arms of people. Well, that's the logistics part, right? And the planning behind that. And it's so much more complicated than people thought. And now we're seeing it, that it's hard. And my other example is, Elon Musk built an incredible company called SpaceX. And I was at a company that hauled the SpaceX rocket from Hawthorne, California to Texas for testing, and then from Texas to Cape Canaveral for launch. And Elon, there was comments that we got from folks at SpaceX are like, it was so much hard. It was so much harder to build the rocket. We thought it was so much harder to build the rocket than it would be to get the rocket to the point where it could launch. But the reality, it's just as hard, right? The logistics of getting that rocket up in the air and getting it to the launch pad is very hard. It's complicated because there's logistics, because there's all these other factors out there that people aren't planning for and thinking about. And so I just think it's a great industry to be in. I'm so glad that Fran Tucker and Dr. Ted Wallen convinced me to go into transportation logistics, and I'm really excited about it. And I think 2021 is going to be a very bullish year. And I would also be reluctant not to mention, I think Brad Jacobs and XPO Logistics, that is basically a publicly traded private equity firm, and I think Brad's done a phenomenal job with XPO Logistics, and I think that's kind of brought more attention to the logistics space. And so I think you're going to see some other deals get done this year, and I think the multiples are going to be at kind of record highs.
Thank you, Paul. Mr. Seidel, bring us home.
I'll try. Well, thanks for telling everyone the age there. Yes, it's been quite some time, but you'll see even the evolution of the name of our department. It's just gotten sexier sounding. So I'm not so sure transportation is sexy, but I think we're sexier these days. And unfortunately, it has taken the pandemic, I think, to shed some light on that, and I think also to shine some light on a lot of the workers, the essential workers across the supply chain that really, really matter out there. And I just want to give a shout out to all the men and women that are, helping keep this company moving on a day-to-day basis, that can't work from home, that have to be out there on the front line, hauling freight all around this great nation. On the acquisition side, I agree with my two esteemed colleagues here. It's going to be a strong market. You have a lot of companies that are in very strong financial positions. You have a lot of investor money looking to be put into play. And I think you have companies now that are exiting a back half of the year that was strong for them on the transportation side. And so the numbers are starting to look good on a TTM basis when you're looking at your EBITDA or revenue. And now you have a better line of sight into more growth going forward. I've always said in the M&A market, it takes two to dance. And I think now we have willing partners on both sides. And I think 2021 is going to be a strong year.
Well, we are going to end early, which I hope is okay with everybody. I just want to close and sort of pick up on what Jason and what Paul said. Thank you to SU for this chance. SU has the oldest transportation logistics practice, is the oldest transportation and logistics school in the world, and you could see that from the three of us. It does a good job, I think. Thank you for everyone who listened to us today. We hope you learned something. Feel free to contact myself or any of the panelists if you have any questions after this. And I'll end with this. I've spent more time in this field than anybody, and I've watched this field grow in many ways. It's going to keep growing. Everything we sit on, everything we eat came through a supply chain. So why wouldn't that be a place that people invest? And with that, I want to thank everyone for being with us. Have a nice rest of your day. And again, if you do have any questions, feel free to contact myself or any panelist. Thank you.